The new BSP governor announced the possibility of further interest rate hikes amidst the upcoming Fed rate decision this week. How will this affect our local stock market? I'm Dan Slim, and welcome to another episode of Monday Market Outlook. The BSP governor announced in an interview on Bloomberg that further rate hikes are more possible for the Philippines compared to a possibility or the lack thereof of a rate cut for this year or for the near future. Now, as it stands, interest rate is already at 6.25%, and we have paused interest rates for the last 4 months. With the upcoming Fed rate hike on July 26 of another 25 basis points, this will put the US interest rate to 5.5%. This may put pressure on the BSP to continue monetary tightening by hiking rates to another 25 basis points to defend the peso, while the September Fed meeting puts the probability of further rate hikes at only 15%. If we look at the target rate probabilities for the November Fed meeting, this probability is at 26.6%. So we may still see further rate hikes in the US. Ideally, we've maintained a 175-200 basis point spread between the US interest rates and the PH interest rate. If you can still recall these periods where the BSP allowed the US interest rates to close the gap last year, we saw the peso depreciate to all-time lows, close to 60 pesos on the dollar. So we are currently at 6.25% with a 100 basis point spread. After the Fed meeting, that gap closes to 75 basis points. Further US rate hikes could possibly close that gap to 50 basis points. Currently, despite US rate hikes, the dollar has struggled overall. The peso strengthening to 54.35, finding a base at that level before depreciating last Friday to 54.72. Now, the tricky part here is that while the Fed will come out with their decision on July 26, the BSP will only meet 3 weeks later on August 17 with their decision. This is quite a long time. 3 weeks is quite a long time for the market to digest this kind of uncertainty, and remember that the market doesn't really like uncertainty. Meanwhile, the Asian Development Bank came out with their projections last week, with the Philippines with the highest projected GDP growth rate compared to its Southeast Asian neighbors. I'm not sure if these projections do take into account possible rate hikes by the BSP governor, but remember that as interest rates go up, this siphons money away from circulation and economic activity becomes slower. So the BSP will have to take these things into consideration before deciding on a rate hike. Furthermore, if we look at inflation, it has already tamed to 5.4%. Ideally, inflation needs to stay below Philippine interest rates, and as of this moment, inflation rate is currently well below 6.25. So what the BSP governor said could probably be just a form of moral suasion. The mere fact that the BSP has shown intent to defend the peso given the need may already be enough to stabilize the market without resorting to an actual rate hike. Against the backdrop of further rate hikes, we saw the 10-year yield stabilize at around the 6.35 level. At this level, this puts the fair value of the PSEI at 6,500. Interestingly, the 6,500 level has become a very critical zone as we see the moving averages, the 10, 50, and the 200 moving averages converge at 6,506. Market breadth has also improved, with around 66.7% of stock above their 10-day moving averages. If we look at the charts, the PSEI corrected at the start of the week and interestingly found support at the 6,500 level, bouncing off strongly to end the week at 6,647. Now, there's just a small bug in TradingView, but it ended somewhere around here. Now, with 3 weeks to go before the BSP rate decision, we could potentially see the index trade along this narrow range, 6,500, 6,650, possibly up to 6,690. But as it stands, we formed a higher low, we formed a higher high. So we're seeing some change in the direction of the market compared to a couple of weeks ago, where we were teetering here on the edge as the market was threatening to break support 6,375. Bank earnings will start soon as we see the banking sector perform well last week. BDO bouncing off 140 support to end at 147.8. Now remember, we are still looking at 155 as our target price. BPI doing quite well. Metrobank finally catching up, showing signs of life, heading towards its next resistance at 59. AP greatly affected by the declining WESM prices as it fell to a low of 34, ending at 35. I think at this level, this could be a good pickup. So ease in carefully as we monitor how AP reacts at this price range. Skipping to our real estate stocks, we mentioned last week that if interest rates may have peaked, could the real estate sector be at the bottom? Shrugging off all talks on rate hikes, real estate stocks bounce off from support lows to end the week quite strong. Ali ending the week at 27.40, well on its way to its next resistance at 28.50, breaking out of its 25.90 resistance here. SMPH steady at 33.30. Now look at RLC and MEG. RLC breaking out of its 15 peso resistance. MEG also same pattern with a strong move to the upside. At this point, the market may already be calling the BSP's bluff, betting against further rate hikes. We also mentioned JFC hitting resistance at 260. Remember that JFC has hit resistance 2 times in the past, and this might be a sign of things to come. But in case JFC does break out this time, we could see JFC head towards its next resistance at 272. If it does happen, wait for the pullback and for JFC to defend 260 before going in. Onto the global markets, we are looking forward to some fresh economic numbers this week, starting with the PMI numbers, followed by the consumer confidence numbers and the new home sales numbers. Now, this will give us an idea on the American consumer as they represent 1/3 of the US economy. Of course, the Fed decision comes in on Wednesday, followed by GDP numbers and core inflation indicators. Remember the PPI numbers coming in a couple of weeks ago, lower than expected, which may indicate better inflation numbers this week. We continue the earnings season with blockbuster earnings this week with some of the biggest names reporting. We have Meta, Alphabet, Microsoft, etc. This is the busiest week for the earnings season. Almost half of the S&P 500 companies reporting just this week alone. By August 7, 80% of the S&P 500 companies would have already reported, and we will now have a better idea on the market direction. But currently, tech stocks are off to a bad start as Netflix shares stumbled after an earnings miss. Also Tesla, despite the all-time high in quarterly revenue, investors had concerns about the declining operating margins, especially after Elon Musk announced further price cuts. So looking at the S&P 500 charts, the S&P 500 remains steady at 4,538. It did peak through our estimated resistance at around 6,450, but had a minor correction in the last 2 days. But for now, we're still seeing an upward trend in the market with no signs of a reversal just yet. Note that this rally is primarily driven by a few stocks as we see the S&P 500 decline. We can filter this movement with the Magman stocks. This is Microsoft, Apple, Google, Meta, Amazon, Nvidia. See this decline here, which represents the decline in the S&P 500. Because if we look at the equal weighted S&P 500 chart, we do not see the same decline in the broader market. Remember that after that huge run-up in tech stocks this year, the weight of the top S&P 500 stocks, especially the weight of the top Nasdaq 100 stock, has become too high, which is why the Nasdaq will undergo a special rebalancing. Now, let's look at the consumer discretionary versus consumer staples graph, where we see a very sharp decline to its critical level at 2.26. Now, could we be seeing a rotation from the discretionary sector to the consumer staples, which is a defensive sector? We see an island reversal pattern here, which may indicate a trend reversal. Now, if we look at the sector rotation, we see KRE, the regional banking sector, with its best performance as banking companies have reported great earnings from high interest margins. Also, the market is probably starting to realize that the reaction to the SBV collapse may be overblown and the banking sector is in much better shape than anticipated. Look at the top sectors here. We have health, we have energy, we have utilities, finance, and consumer staples. And at the bottom here, we have consumer discretionary, we have semiconductors, and we have the tech sector lagging. Even as we zoom out to the monthly time frames, we can still see the defensive sector outperform. Could this rotation foreshadow tech earnings? Now, because a rotation in the market means that investors are anticipating a recession, and rotating into the defensive stock means that they are protecting themselves, as movements into the defensive sectors provide better protection as they are less susceptible to a downturn in the economy. So we'll see. Make sure to subscribe to the channel as we monitor these developments. Please like this video if you found the information useful. And as usual, good luck on your trades, manage your risk accordingly, and we'll see you again next week.